Welcome to the Real Estate Show on KMED this weekend. Pete Belcastro and Joe Brett, the Real Estate Guys, with you, and thanks for being with us on this first weekend of October of 2014. Joe and I get together with you, as you know, every weekend right here on KMED, and we talk about issues facing real estate across the Rogue Valley in Oregon, even across the country sometimes. We got great guests each week, and of course, we thank you for being with us and all that kind of stuff. You can also contact us at email. It's peterjoe@realestateshoworegon.com.
It's October. That means it's the month that the holidays start. Not till the very end.
Well, you can't get too excited because you overstep you get too worried.
I just can't wait for Thanksgiving. It starts at Halloween.
Anyway, we'll talk about that later along. Well, we'll talk about mortgage interest rates, and Guy Giles with us from Summit Funding. Guy's one of our resident experts when it comes to mortgage interest rates. He's right with it every day, right? I mean, you do this, you're like, yeah, a thousand transactions in a month is an awful lot for any company. Wow, that's a lot. It's a pretty healthy market around.
Well, yeah, we didn't do quite that many in the Rogue Valley, but that's a little more company-wide.
I thought that's how many you did last month.
Yeah, that was the first half of the month, and we had some other ones. But now we're still growing, so that was kind of a milestone for our company, which was kind of nice. That got announced yesterday that we closed over 1,000 loans for the first time. But as people are hearing about us, we're just trying to pick up a little market share here and there. So it's working out.
Obviously, they're finding their experience to be like yours with Summit Funding when you did a deal with them, and all of a sudden we're more interested in being more than just someone who did a deal with them.
It's nice. I went to a signing yesterday at 10 a.m. By the time I drove back to my office, I had an email that we'd already funded. And, an hour later we were recorded, and it's nice being with a place that's just functional in that way.
Yeah, your client probably shared that excitement too.
I'm the real estate agent. That was kind of nice.
It's wonderful when it all works and it comes together. Yeah. But it's a partnership, I think, more than anything else. It's a team. As we've learned, you got to have the title company. You got to have the person knows what they're doing there. You got to have the right lender who sometimes talks to the title company and talks to the brokers. Otherwise, they sit in a vacuum and you don't know what's going on. And the biggest complaint, with real estate, I'm sure, I would bet it's in the same thing with mortgage lending with clients, is that they don't feel you talk to them enough. Communicate with them enough, often enough, those kinds of things. And you always have that, I know, in the back of your mind, don't you, when you deal with people?
Oh, yeah. Yeah, and that real estate agent part of it's really, really important also. Kathy Bauer was the agent on that one, and that house actually appraised for about $7,000 more than the guy was paying for. So that's a really nice thing to just walk in on the day that you close on your house with that kind of a profit. So it definitely helps to have the right people around.
Yep, it's nice to people making profits on their homes again versus having to, forced to sell them and forced to short sell
them. And a more level
money.
marketplace without the distressed properties dragging sellers with good equity homes down. It's kind of leveled out a little bit more like it's supposed to be.
It's pretty encouraging. Let's bring in our other guest with us today, Dave Kamammer from Summit Funding. Dave's up in Eugene, and we refer to Dave as Guy's boss. I guess we can do that. Dave, are you still there with us? Joe, what have I done here? Did I do something there? Oh, there we go. Right. There you are. Where we got you now? Welcome to the show there, Dave.
Thank you very much. I appreciate it, Pete and Joe. Hey, listen, it was 1,066 loans. I'm a detail guy.
I didn't know you could hear all that.
Wow. 1,000.
No, I'm paying attention. Yeah. And, you mentioned something about communication. And a couple of years back, actually, J.D. Power, you've heard of J.D. Power & Associates, of course. They did a survey of people who did home loans. And the number one complaint was lack of communication. Mm-hmm. Number two was not closing on time. Number three complaint, most common, was not getting what they were promised. So in other words, either the rate or the fees or whatever. But number one was lack of communication by far. So it's interesting you were bringing that up today.
That really is, isn't it? And it's so true.
People have so much on the line and so many different moving parts as a deal is in escrow and moving towards the closing that they hate to just be left out hanging and not knowing, even on some of the most minute details. I mean, just being reassured that things are moving forward and are on track means the world to clients.
Is there here's a good question. Is there a tracking system, Dave or Guy, that is used in the mortgage industry to track just the things that you talked about, customer satisfactions, or do companies do that themselves? Do you close on time? Those kinds of things. Is that tracked?
Well, that's a great question. I'll tell you what. To my knowledge, there's nothing specific industry-wide, but I will tell you, our company is very diligent about that. We actually send a survey to the closing table along with the closing documents on every single client. And each month at our monthly meeting, we have a team meeting in our whole branch every month, and I read those surveys, and they're rated, excellent, good, fair, poor. We read them all.
Mm-hmm. And that's the other part. I'm sitting there at the signing table with these guys, and when they're filling out that survey, I want to make darn sure I did a good job for them, and they're happy when they're filling that out.
I told Guy that just because he's in Jackson County doesn't mean he can wear a sidearm to closing, because I think it intimidates the client. So all of Guy's surveys are really good for some reason. Most of our company surveys are really good anyway.
We got a few clients that wear their sidearms anyway.
That's my favorite.
But in all serious, gentlemen, we do track it, and then there's also some tracking mechanisms within our company, and I mean, Guy will tell you this, but we track everything. That's one of the attractions that I had at this company, and Guy has this company. There's a lot of accountability. I'll tell you, people who want to be professionals and be A players in the business, they appreciate a company that takes their tracking systems that seriously. And guys, that's what it takes to close loans on time and give good customer service. You got to have the power behind it.
Yeah, I think you're absolutely true. Well, okay, let me ask you this. Does it happen, mortgage rates, we talk about that in the fall, how it changes in terms of regular real estate, residential sales, go down a little bit, things go down, slow down. Does that happen? How does the mortgage industry deal with the fall, winter months that we're approaching into?
Well, okay, so it's regional in nature. If you think about it, weather doesn't impact every part of the country. Like if you think about places like Phoenix or Southern California, it really doesn't change. Florida, it doesn't really change, okay? So there is some regional changes. Now, of course, here in the Northwest, things do slow down a little bit because the home buying season, if you will, really starts somewhere around February, March, kind of peaks in that right before school's out period of time, then it kind of hits it hard again in August, September. That's a standard trend. I've been in this business 20 years in the Northwest, and that's been very common. What's interesting is that demand does have something to do with what happens to rates, but there's also some other macroeconomic factors that impact rates. In general, if you look at historical data, which that's what we do when we look at stock markets and everything else, there's always some kind of downward trend a couple times a year in rates. One of them happens in the mid-fall, early fall, like sometime in October, and then they kind of inch up towards the holidays, and then there's another drop in the early part of the year, which for us is the dead of winter. And I think it relates a lot to demand.
Do you think?
Makes sense,
okay.
Yeah.
Do you see that coming ahead this winter? Because what are rates today? I mean, the range of rates right now.
Rates have just been hanging out.
We haven't got given numbers for some time. So what are the rates that people are? Because we talk about they're coming down, this kind of thing. What are they right now?
You got to be real careful when you're doing that, because there's about 26 things that go
I understand that, but generally speaking, what's a range that someone
in the next 30 seconds?
Yeah.
So guys, Joe and Pete, Guy, I've got this because I'm prepared. So here's
what I deal with.
Okay. So this is on a $200,000 purchase with 20% down and somebody with a 760 plus credit score. Okay.
Right.
So today the interest rate on a 30-year fixed conventional would be 4.25 with a 4.351 APR. Okay, and that's a middle of the month closing, 15 days of interest. So we have to say those things because you've got to quote an APR when you quote a rate in a public forum.
Yep.
So that's what they're doing. Now, within that range, if your credit score is lower, your interest is going to be higher.
Right.
If you put more down, or if you have a larger loan amount, your rate could be slightly lower. So there's a lot of things that impact rates, but that's kind of a midsection. Now, a government rate like an FHA or VA is probably going to be a little bit lower than that, but you're going to have a higher APR because there's funding fees with the VA loan, and there's also mortgage insurance with the FHA loan.
Sure
so
is.
the note rate's going to change. Now, the cost of money is cheaper right now because there's a lot of money out there looking for a place to park itself, but there's not as much demand. So when there's more demand for interest rates than there is supply, that's when rates go up. But right now, there's less demand for mortgage money, and mortgage-backed securities are considered a fairly safe investment right now. Plus, there's other investments that are considered safe, like 10-year treasuries, not just U.S. treasuries, but treasuries around the globe. And some of the rates at those areas, like let's take Europe, for example, those rates are much lower than what people can get here. So there's some more demand than we expected. So even though the Fed is kind of cutting off the bond buying program, there's a lot of trailing bond desire, if you will, or demand out there, and that's what's holding rates low right now.
Boy, that sounds good. That sounds like a pretty good deal, though. I mean, isn't that? I mean, I like that.
We look a lot better.
It's short term, gentlemen.
Yes.
The prediction is that by next spring, you're going to see rates go up. And I think the Fed's going to back off. And they're also saying things like, if you listen to Janet Yellen, she mentioned that she didn't say the date, but she said for a considerable time they don't plan to raise the short-term interest rates. And there is a relationship between the long-term and short-term interest rates. But right now, the Fed, owns what, 1.2 or 3 or 4 trillion dollars worth of mortgage-backed securities and other bonds they've been buying since QE3 started. I mean, that's a lot of stuff. Those things, just the fallout of $1.4 trillion. You understand that $1 billion is 1/1000th of a trillion. So just the fallout of maturity levels. Some of those bonds are maturing right now that were meant to go longer term. So that money's got to be reinvested. So that money's still going to get thrown back into the market. Does that make sense to you guys?
Yeah,
no, it actually does. No, we'll see what's good interest. You predict it to come down, then so you think by next spring we're going to see it above 5% kind of thing.
I think
I
don't know
about 5%, but it's about demand.
Yeah.
If you see a really strong demand, here's what's going to happen. Rates are going to drop. People hear that. Honestly, sometimes that slows down the home buying process because folks say, well, okay, they're going to be low for a while. Maybe I should back off and see what happens to
see if they get lower.
Property values. And then the minute the news says, hey, rates are going up, it's on an upward trend. We've seen this twice this year where rates started to spike, and there was a huge amount of immediate demand for housing. It was very noticeable.
Just the news would create that kind of a market.
And Dave, isn't that a little backwards? I mean, don't you want to be in front of the spike instead of having the spike?
I know,
I hear what you're saying, though. I can see that, yeah.
We're talking about most people operate on herd mentality, and let's face it, that's the facts. And so you're somebody who's thinking about buying a house, but you're putting it off. You're thinking rates are going to stay low for a while, but that's part of the reason you're thinking about buying a house because rates are low right now. And then you hear, hey, rates are going to start to go up. You've been looking at houses off and on in Sunday paper and stuff like that. All of a sudden you hear, hey, rates are going to go up 0.5% or maybe even 1% in the next 30, 60, 90 days. You're going to get off your duff and go shopping.
Yeah, because your buying power is going to get crushed if you sit on the sidelines.
Mm-hmm.
So when that news comes out, it pushes people up. And when the news comes out that rates are going down, I mean, what you hear is, hey, can I get a better rate on the loan that you already locked for me? That's for us guys that have already locked in rates that haven't closed. That happens. And that's part of the business. That's okay. And then also there's people that couldn't refinance before, and they think, hey, maybe I should try to refinance now. And then on top of that, folks who are buying, it's like, okay, I've got maybe a little bit more time to shop and find the house I really want, because some of that demand is pent-up demand, and people are buying houses because they're afraid values are going up. So, as you know, somebody will make a decision. Maybe they won't buy the perfect house.
And speaking of values, I just want to remind our listeners, Joe, that on the last weekend of the month of October, Josh Gibson, who is the Jackson County assessor, comes in for his yearly visit with us because you know what that means. Property tax statements are in the mail, and we've had, and he will tell us at that point. You remember, January 1st is that time when the new real market values and all the kinds of assessed values come onto to the world. And so remember, our values have risen the last 2 years. Remember, it went down for 5 or 6 there, and now they've come back. We'll hear what's happened this year, and we'll find out at the end of the month. Anyway, I'm sorry to keep going on that one, Guy.
No, that's fine. I think the only thing that I want to add to the whole rate debate here is that Europe doesn't look very strong. Right now.
Doesn't.
So I think that there's still going to be a whole lot of money that's generally been flowing into the EU that's going to kind of trickle its way over here. And even as they start pulling back on these asset purchases from the government, not to get too deep into a bunch of weird stuff, but people are looking for, like Dave said earlier, a safe place to put their money. Yeah. And they didn't raise their rates. I think it was today that they talked. These days are running in together this week. But they were talking about not raising rates, but just doing some kind of a monetary stimulus that they didn't do. And rates reacted for a minute, but even after not doing that, you see that they just kind of came right back down. And we had, I think, 2 or 3 midday price changes today going up and down and all over.
Yeah,
but I think at the end of the day, I think you're right. They do have to go up. And if you can,
they do have to go up.
I'm talking to people anywhere from 4.1 to 4.3. Right now. So rates are really, really good.
And my buying power, especially if I'm in that first-time home buyer or in that under $200,000 range, there's a big impact on my ability and my buying power.
It adds up. Yeah. I've done that math quite a little bit the last few days as far as how that just an eighth or a quarter will add up in the long run. But I don't know. It's still a good market. Come on out and buy.
Oh, no, yeah, it is. Yeah.
Well, absolutely. We're up against a break here coming up. But when we come back, though, I want to, because I know Dave probably has this information in his head, but of the 1,000 loans that you did,
1,066.
I'm saying, that's right, 1,066. Yeah. Of the loans that you did, about how many of those now are becoming FHA loans versus conventional loans versus kind of USDA loans, kinds of things? So what are people buying today? Because, again, it was 80 when we started our show not that long ago. 87% of all loans were FHA loans, and has that changed with the market as things have gotten better? Anyway, that's one of our things to think about as we go along here on the Real Estate Show this weekend, right here on KMED.
The world economic scene scares me, keeps me awake at night more than anything else.
Yeah, that's true. Next week we'll be on with Laurel Adams talking about rental markets in Jackson County and things like that. This show repeats at 9 o'clock on Sunday mornings right here on KMED. Of course, all of our shows are available on youtube.com/Real Estate Show Oregon. Hope you'll check them out there. Don't you dare go away. The Real Estate Show continues right here on KMED right after this. Real Estate Show rolls on here on KMED this weekend. Pete Belcastro and Joe Brett, the Real Estate Guys, with you. And thanks for being with us on this first weekend of October. As fall rolls around, beautiful fall days. Best time of the year right now in the Rogue Valley, I think. Got some rain. That was good, we need some more, all those kind of things. But other than that, it's a typical fall. Football season underway, lots going on, and a lot of festivities, and from harvest festivals and on down. So I love this time of the year. We're with Giles, and from Summit Funding, along with Dave Kamammer. Dave's in Eugene with us, and of course Joe is along here as well on the Real Estate Show, talking about mortgage interest rates and kind of that world that Guy and Dave hang out in every day, and they're bringing their expertise and share with you today on the Real Estate Show. Okay, Dave, let's go on that, because again, one of the things that our listeners know, if they follow us, is that how the market has changed since our shows began over 5.5 years ago. And I can remember, we had 75%, almost 70-some percent, foreclosed properties were the sales and rates and this kind of stuff. And well, now, so we've changed it around. Mostly we're FHA loans because nobody else could get a loan. So of the 1,066 or so that you guys, I don't even give me the numbers, but what are people buying today in loans? And you even said about 20% down. I haven't heard anybody telling me that 20% in a long time. So so we'll let you go on that one.
So, Guy, you want me to handle this one?
Yeah, either way. Go ahead.
Listen,
I think I'm in a little different market than you down here, believe it or not.
Yeah, well, I'll give you the macro version. So company-wide, we're about 30% FHA, about 10% VA, and the rest is conforming and non-conforming. Now, our company does business in some markets that are, what we call jumbo markets. That's also known as non-conforming. So about 10% of our loans are non-conforming.
Tell people what's the mean conforming, non-conforming. Tell people what that means.
Conforming is the same as conventional. That's Fannie Mae, Freddie Mac. That's the regular 30-year fixed conventional loans you hear about require minimum 5% down.
It's basically the loans that the government allows FHA and Fannie Mae to buy. They won't let them buy it, like in this area, over $417,000.
That's a conforming loan.
Yeah.
Okay.
Yeah, and non-conforming, another word people use jumbo all the time, but non-conforming is just everything else that's not a conforming loan. It's not government. It's not. It used to be. That's actually all it is just jumbo loans. But there's some funky ones in there. I mean, those are companies that still do a lot of what we call the 5- and 7-year fixed period adjustable rate mortgages, because they're much bigger mortgages, and those borrowers take more risks. They're more savvy. There are larger down payments are required on those. So we are seeing, I don't know, Guy, your market might be slightly different, but we're seeing about probably 20% of our loans are 20% down. A lot of them are 5 and 10% down conventionals. In our market here in Eugene, I would say about 30 or 40% of our loans are government loans. The rest are conventional loans.
Yeah, and I think the only thing I meant kind of by different is I'm having a ton of people move up to the area that are buying second homes and different things that do have down payments. So, the one yesterday, a couple of them, I think we signed 3 yesterday, where 2 of them were 5% and one of them was 50%. So, I mean, it's
all
still
over the board.
It really is. But But I mean, there's also some other things. We've always thought of conforming loans as far as what Fannie and Freddie will buy, but there's still a whole other segment of the market, which is what they call portfolio loans that banks will do. And I had a unique one yesterday where the lady, they've changed the rules to where you have to have, if you have a short sale, you're 4 years out, no matter what. With 20% down, you used to be able to go with less years. And some of our portfolio products, I actually have a lady that's only 3 years out of that, and one of our brokers is willing to do a loan for them with a good down payment, with 20% down, and get them into a loan, even though she hasn't met that seasoning requirements. That's why it's nice to just talk to us sometimes about, just conforming. We are direct lenders, so we get the best deals from Fannie Mae and Freddie Mac, but also on top of that, we have the access. I think I counted 34, Dave, you can correct me if I'm wrong, 34 or 35 people that we can broker to that are looking for people that may have got into a little bit of trouble in the past, but still they think they're a good bet.
Yeah. That's a great option for a client to have. I mean, basically, you come into your office and you've got everything. You can lay everything out on the table that's available to mankind.
Yeah,
and we can match your situation and your circumstances.
And that's one thing that, first of all, we try to do them in-house, and we do a ton of in-house loans. And then if that doesn't work, then we kind of go out to some of the bigger banks. We can look to those guys. And then we have a third layer, which is our brokered products. So we can, if it can get done, we can generally get it done.
When you talk about down payments, and that's something that so many people struggle with. So wouldn't you advise people, Dave or Guy, when you advise people, I got 5% down or 20% down, or I may have enough of that, but how do you determine with the client whether 5% makes more sense to me or 20% makes more sense to what I'm doing? Do you deal with that at all?
Go ahead. That's a really good question. And here's why. Listen, we're not licensed financial advisors or planners, but most of us have some certified mortgage planning training. Mm-hmm. And what that entails is there's a number of questions we ask people, and it relates to how long that they plan to have the home, what their plans are in the future, what kind of income they're going to have in the future, things like that. Because all those speak to how long they're going to have that mortgage. In general, here's what I try to do. I try to tell people, we're going to use the least amount of your money to own this house while you own it. That's what our job is. And that's a math equation, and it takes asking a number of questions, and not everybody's going to be perfect. So without knowing the exact answer, we use 10 years as a window for that kind of calculation.
Okay.
Now, as far as somebody, should they put 20% down or 5% down, it really depends on what's more important to them. And we show them the options there, and they might have a financial money manager who would say, hey, put 20% down because that's a better deal, or don't put 20% down. Give me that money, put as little as you can down because you should leverage your house. And that varies from one person to the next. So we give them that option. And honestly, I don't find very many people who, A, have that option, and then, B, are confused about what they should do.
Okay.
Usually they have the answer. Does that make sense?
Yeah. They probably know what they have coming into the transaction.
And that's another nice thing about even the way that we're compensated. It doesn't matter to me if you do. I mean, it matters to me because I want to get you in the right program. But if you do the craziest, believe it or not, there's still interest-only products out there. You used to pay more. The banks used to pay more for getting people into things or doing prepayment penalties. So good or bad, some of this QM stuff is actually just kind of even the playing field. So we have all the incentive in the world to spend that extra time, find out what's important to the borrower. We're not getting driven by a big bank that says, hey, we need to fill our government loan bucket this month or something, So we can really just sit down and find what the best product is for that person. I think that's kind of what Dave was speaking to, that we, it's just really important for us because, we're a referral-based business and we want people to walk out of there happy.
These are the questions your clients are not going to ask themselves. They're excited. They're in their late 20s or early 30s. They're buying their first house. And they're not thinking of, where am I going to be when this mortgage comes due? What is my financial situation going to be? Those are very important questions and very important parameters to put out in front of your client to help them make that right decision and to find, basically, in the end, it sounds like you ask the right questions and the steering takes care of itself.
Yeah.
And you get to what the product that you want that's going to serve you best. And for, we don't ever know what's going to happen in 20 or 30 years, but for what you project of what your future is going to be.
Yeah, that would just be like on you guys if you just walked out and said, somebody said, hey, I want to buy a house, and you just went and showed them a house. You got to ask them some questions.
I got one on 2nd Street. It'd be perfect for you.
Oh my gosh. So it's just nice to find out what their goals are too, and it's just a good thing we do.
Well, I like what you said, what you both said about having people keep more of their money, and not just because I have it or something, just to say if maybe lower my payment by $20 or something, but keep your cash as much as you can. I think that's I've heard that with car dealers have said that to me as well over the years, that I don't know how accurate all that is, but it does make sense because you do want to keep more of your own money.
And that money that you keep can work and provide for you, can go to work for you in other ways.
And it can definitely drop down. If you're locking in at a 4.1% rate today, and you're able to make some money, somewhere else. And again, we're not financial advisors, so I'm not telling people, hey, just take all the equity out of your house and go. I don't mean it like that at all. But people that have the wherewithal to pay that mortgage down if they ever needed to, if they could utilize some of that money to do something else for a while, it's not always a bad thing.
Nice to have options too, and some security and some leverage as unexpected things may come up, and you go forward.
We got a break coming up here again. That last segment, we're going to ask Dave and Guy, what are special products out there? The industry has.
We have special needs.
All sorts of things that you hear about that are out there. That you can do this, you got this. Anyway, so we'll ask them about some of those things, and maybe some listeners may want to.
And if anybody's got a cool hair product, you can call in and tell me about that too.
All right, the Real Estate Show rolls on here on KMED this first weekend of October of 2014. We've been with Guy Giles and Dave Kamammer from Summit Funding. One more segment to go. The show repeats at 9 a.m. on Sunday morning, and all of our shows are available at youtube.com/Real Estate Show Oregon. Hope you'll check them out. We're coming right back after this. Real Estate Show continues here on KMED this weekend. Pete Belcastro and Joe Brett, the Real Estate Guys, with you. Next week, Laurel Adams. We're going to talk about and catch you up on the rental market in Jackson County and what's going on with that. 2 weeks from today, Joe will be along here with Tycourt Title, and Frank will be with bringing some guests in the commercial world around us, and economic development, jobs, things like that are really important.
It'll only be the most interesting and informative commercial real estate show that you'll hear anywhere in the valley this fall. So be there or be square.
Last weekend of the month, Josh Gibson, the Jackson County assessor, will be here.
We can grill him.
I can't wait for that, because I'm so curious as to how we see so much about rising values and where they're rising, and he'll bring us up to date with that. Remember, you're a year behind. Remember, so this is
18 months.
18 months behind. So this is his thing on January 1 really is from like a year ago.
I'll have to take him through Southwest. Take him through my neighborhood after the show.
It still doesn't make any sense.
I'm going to drive him through my neighborhood. I think we're lagging a little in the valuations there.
Makes no sense.
No, that's not a good idea.
Makes no sense out of the deal. Okay,
have him over to my house.
We're talking today with Guy Giles and Dave Kamammer from Summit Funding, our resident experts on all things mortgage interest rates on the Real Estate Show. And thanks for being with us. All right, are there products out there in the mortgage world that are new or innovative or something like that you're offering to people who might want to take advantage of them? Is there stuff out there?
I'm hearing about Dave. If you can go first, or I can.
So, Guy, okay, there's a couple things. One, within the realm of FHA loans, there's a couple of really neat things they're doing. One of them is called the Back to Work program, and that's been around for about a year. And the Back to Work program allows us to give somebody an FHA loan only 1 year after bankruptcy or 1 year after foreclosure, but we have to demonstrate that it was an economic event out of their control.
Right.
And we have to demonstrate that they lost at least 20% or more of their income for a minimum of 6-month period, and that's what precipitated this bankruptcy or foreclosure. And we've been able to effectively get people into homes. Okay.
Mm-hmm.
FHA also allows somebody who does a short sale, and they do a short sale because they need to move for work or something like that. As long as they didn't make any late payments, they can immediately buy another house. They don't have
immediately.
There's no seasoning period. Yeah. So there's some neat things in there, and that's why it's so smart for people to get advice from a good mortgage planner before they start doing things like not making their payments or whatever.
Yeah, I was just going to say, we learned so much, Dave. It's just gold nuggets here you're bringing.
Well, and number one is you got to keep your payments up, because once you get behind, you're really
There was a time when that was a good strategy, just to let it go.
And how many times did we have guests and tell us that was happening? People just said, "I'm not paying.
Yep.
I can't do it. I'm done."
I got to tell you, those people are getting punished now, and it's just here's what lenders look at. Just think about it. You're loaning. Just pretend that you're the lender. Somebody has demonstrated a character trait where they could have made the payment but chose not to.
Okay. Yeah.
Will you loan them money again? No. Somebody else has demonstrated the character trait that they did everything they could to make the payment, but they were unable to because of circumstances out of their control. But before and after that event, they demonstrated good character traits in lending, borrowing. Who would you loan your money to?
Dave, I'd probably loan to the guy with the hard luck, because that's why I'm a realtor and not a lender.
And guess what? The lender thinks the same thing too. Yeah. The hard luck guy who was down on his luck is the one that we rolled loan our money to.
Yeah.
The guy who could have made the payment but chose not to, we won't make.
You won't make the payment. They won't make the loan.
Do you realize that a foreclosure, a conventional lender will make you wait 7 years now after a foreclosure?
Yeah.
It's 4 years for bankruptcy and short sale. It's 7 years for foreclosure on conventional loans. It's still only 2 years on FHA. I'm sorry, 2 years for bankruptcy on FHA, 2 years for bankruptcy on VA, and it's 3 years for bankruptcy on USDA. And then foreclosure is 2 years VA, 3 years FHA, 3 years USDA. The only exception is that on FHA you can use that back to work program, or if you didn't make any of your payments late on the short sale.
Do you see many people coming to get loans with those things that you just described?
Absolutely.
They are, really?
I have people, listen, as mortgage planners, people come to us because I find a lot of them go to the real estate agent first because they are interested in a house. Mm-hmm. And the smart realtors that work with us are saying, hey, go talk to a good lender. They get in front of us. Because a good realtor is going to quiz them. Are you pre-approved? No. Yeah. Mm-hmm. Are you divorced, bankrupt? Did anything like that happen? Because 9 times out of 10 something bad went on these days. And go talk to this lender over here, and we will dig it out of them. And I've had people that think, hey, I know I'm not going to be ready for a year because I had this go on. And then I look at their stuff and I go, you know what? I think you can buy it today.
Wow.
And that's happened a couple times in the last few months, and it's been a real pleasant experience for me to be able to show somebody that one. That's exceeding expectations instead of meeting or not meeting expectations.
Yeah, that's good advice though too.
Something else has changed recently. I think this is significant, and I want to get the word out on this. Mm-hmm. We used to punish people, as this is conventional loans lending, because what would happen when somebody go bankrupt and then they'd lose their house, right? Mm-hmm. But then that house, does it go in foreclosure and go through foreclosure at the same time that bankruptcy happens? Never. So what was happening? Somebody would go bankrupt, but then their house wouldn't actually get foreclosed on. Sometimes 2 years later.
Right.
We were using the later date for the seasoning period. Now, if we can prove that mortgage was included in the bankruptcy and it wasn't reaffirmed, even though it took 3 years later for that thing to actually go through foreclosure, we're now using that bankruptcy date as the original seasoning date. And that's significant because now there's people who couldn't qualify before because of seasoning after foreclosure, and now they only have to wait till seasoning after bankruptcy.
Well, it's amazing what's still out there and that take advantage. And I know, boy, Joe and I have learned, and I know our listeners have, Dave and Guy, is we send them to the mortgage person first. And you're right, because you have to know what you possibly can. The worst part for a broker is to go show somebody say they have this much, if they think they have this much money, they haven't been pre-approved. You waste your time to go show them houses that they can't qualify for. Then they get disappointed and discouraged because they started off wrong on the wrong foot. You got to do it right, or it doesn't work, I think.
Yeah, and even sending them to somebody that, like Dave said, I'm a certified mortgage planner also, and it's one of those things that. I had somebody come in saying they were ready to go approved, and some lender had approved them off of an email that his potential boss sent them. And I said, "Look, man, you're just not ready." But it's just good to have all the facts the right way.
Well, it's good to know that you guys are on the case of mortgage lending, Dave and Guy. So we're going to be out of time. So thanks a lot. And Summit Funding, Guy's here in Medford, and so Guy, how can they get a hold of you?
Best thing, my phone number is 541-944-6987.
All right. Guy Giles at Summit Funding. Dave, nice talking
to you.
Great
job, Dave. Good
Thank you, Joe. Thank you, Pete. Have a great day.
Yeah, we'll talk to you next time. Guys around us as well. At the end of November, I think it is sometime. That'll do it for the Real Estate Show this weekend here on KMED. Thanks for being with us. This show repeats at 9 o'clock on Sunday morning. And all of our shows, check them out at youtube.com/Real Estate Show Oregon. We'll be back next week right here on KMED with another terrific show. Hope you'll join us then. Please tell your friends. Have a great week, everybody, and God bless.
Thank you for listening to the original Real Estate Show with Pete Belcastro and Joe Brett, the Real Estate Guys. For advice, guidance, or counsel on any of our topics, or to watch a replay of today's show, visit our website at realestateShowOregon.com. This show is sponsored by RE/MAX, Ideal Brokers of Southern Oregon, Ticor Title, All Cities Property Management, and the Jackson Soil and Water Conservation District. We'll continue our weekly quest to enhance the value of your property and to make you a smart real estate consumer when we gather every Saturday and Sunday on KMED for the one and only original Real Estate Show.